You're scrolling a listing at 11 p.m. The number under the estimated value is $60,000 higher than the asking price. Your stomach does that little flip. This is the one. That feeling isn't analysis, that's excitement. And excitement is how new investors get hurt. A deal can have a low price, a motivated seller, equity on paper, a big spread between what you pay and what you think it's worth, and it can still be a bad deal. New investors confuse interesting with good, cheap with profitable, and a motivated seller with a safe opportunity. So let's break down how to know if a deal is actually good. Not exciting, not popular, not something that sounds good in a seminar. Actually good. If you're new to this, it's hard to know what to trust. A seller may tell you the property's worth more than it is, and a wholesaler may send you clean numbers that leave out real costs. And an agent may talk about the upside, but not the downside. And a seminar may show you simple examples where every deal looks obvious. And online, people throw around phrases like, this has equity, this is below market, this cash flows, this is a no-brainer. And none of that proves anything. Those are claims. And a good deal has to survive the numbers, survive risk, and make sense for your strategy, your resources, and your ability to execute. And this is where beginners need a better standard. The question isn't, could someone make money on this? Maybe. The better question is, can I make this deal work based on realistic numbers, realistic cost, realistic risk, and realistic exits? That changes everything. A deal that works for a contractor may not work for a beginner. A deal that works for a cash buyer may not work with expensive financing. A deal that works for a landlord with deep reserves may not work for someone who barely scraped together the down payment. A deal isn't good in the abstract. It's good only when the numbers, the risk, the exit, and the investor all match. I'm the insider, and I built Seminar Insider to help new investors understand this business before they overpay for coaching, seminars, or high-ticket trading. One of the biggest protections you can have as a beginner is knowing how to judge a deal without needing someone else's hype to hype it up for you. Once you know how to test a deal, you stop being impressed by confidence and you start asking better questions. Here's the framework. Test 1. Value. Before you know if a deal is good, you need to know what the property is realistically worth. Not what the seller wants, not what the listing says, not what an app estimate says. Realistic value comes from comparable sales, similar size, condition, age, neighborhood, buyer demand. You're flipping it. You need a realistic after repair value. You're renting it. You need value in realistic rent. The mistake beginners make is grabbing the best comp instead of the most honest one, building the whole deal around one renovated house that's sold high. And that creates fake profit on paper. A good deal starts with the realistic range, not one perfect number. Test 2. The total cost. Most beginners stop at purchase price and repairs, and that's not the whole cost. You have to add closing costs, financing, insurance, taxes, utilities, permits, holding costs, selling costs, commissions, vacancy, management, reserves, and the repairs you didn't see coming. Say your property's worth $250,000 after repairs. You can buy it for $160,000 with $40,000 repairs, and that looks like a $50,000 spread. Now add in the closing costs, holding costs, financing, insurance, and a cushion for surprises, and that spread shrinks fast. The spread isn't the profit, it's the starting point of the analysis. Test 3 is the margin. Margin is what's left after the real costs. You have to ask yourself, does this deal work if things don't go perfectly? Because they usually don't. Repairs run higher, projects run longer, rent comes in lower than the pitch. If a deal only works when everything breaks your way, it's not a good beginner deal. And real estate always carries risk. A good deal just isn't so thin that one surprise will wipe it out. That's the first big aha. A good deal isn't proven by one exciting number. It has to pass value, total cost, and margin. Now, if you want help avoiding beginner mistakes before you buy real estate education or make a serious investing decision, then download the free Seminar Survival Guide in the link below. It'll help you slow down and ask better questions instead of getting moved by pressure. Now let's keep going. Test 4 is exit strategy. A property isn't a deal until you know it makes money. Flipping, renting, wholesaling, holding long-term, refinancing, each one runs on different math. A flip needs resale value, repair control, and enough profit after selling costs. A rental needs rent, expenses, reserves, and long-term demand. A wholesale needs enough room left for the end buyer to profit after your fee. The same house can be a good flip in a terrible rental, or the reverse. So don't ask, is this a deal? Ask, a deal for what? Test 5 is risk. Deals look good on paper because the spreadsheet doesn't know what you can go wrong. An older roof, a tenant who hasn't paid in months, a slow permit office, a contractor bid that's too low, funding that isn't actually lined up. So ask, what can go wrong? How likely is it? And what would it cost? Can I survive it? And can I verify it before closing? A good deal isn't just upside. It's upside with risk you actually understand. Test 6 is fit. A deal can be good for someone else and still be wrong for you. No rehab experience? A heavy renovation probably isn't your first project. No cash reserves? The thin rental will stress you out fast. No local relationships? An out-of-state deal is harder than it looks on a spreadsheet. A deal has to fit your time, money, skills, network, risk tolerance. A good deal isn't just a property problem. It's an investor fit problem. Now here's the insider breakdown. How bad deals get made to look good, what they show you. The upside. After repair value, purchase price, estimated repairs, project, the profit, the rent, the equity, the best case version. It makes the deal feel obvious. What they leave out? Conservative comps, transaction costs, financing costs, holding time, vacancy, hidden repairs, selling costs, reserves, your experience level. And what happens if the deal doesn't work? What you actually need to know? A deal has to survive a more honest version of the math. Conservative value, real costs, a cushion, a stress-tested timeline, and an exit, and an honest answer to whether you're the right investor for it. If it only works in the sales version, it doesn't. Now here's your good deal checklist. Before you call something a good deal, ask what's the realistic value and what costs support it. What are the total costs, not just the purchase and repairs? What's the margin after real costs? What's the exit strategy? What could go wrong? Does this fit my resources and my ability to execute? And would this, what would make me walk away? The last one matters the most. If you don't know what would make you walk away, you're probably already too attached. Good investors aren't trying to force every deal. They're trying to find the right one. So how do you know if a real estate deal is actually good? You test it. Don't rely on excitement, seller motivation, or someone else's confident numbers. Test the value, the cost, the margin, the exit, the risk, and whether it fits for you. That's how you move from guessing to analyzing, and that's when real estate starts becoming less emotional. Again, download the free Seminar Survival Guide in the link below if you want help avoiding pressure, confusion, and expensive beginner mistakes. And when you're ready for a lower pressure way to learn deal analysis and beginner strategy, then check out the ball. Now this is part of the deal analysis and investor math playlist. Next, watch the 3 numbers every beginner investor needs to know, where I break down value, cost, and margin in more depth. Then watch how investors decide which deals to walk away from, because once you know how to spot a deal that might be good, the next skill is knowing when to pass. Sometimes the deal you avoid is the one that protects your future.